Bitcoin only cause I got that mad cheddar. Bitches and Bitcoin go so good together. Make it rain with Bitcoin cause I like it way better.
Hi guys, good evening. This is Shaibu Mama and welcome to Crypto Mama's channel. Today we'll be taking a look at the W pattern. We've already looked at the M pattern in the first part of this series. So if you have not watched that particular video, check the link of that video in the description of this video. You see the link so that you can be able to watch it. So without wasting much of your time, let's get straight into the video and try to explain how the W pattern actually works and how you can trade it in a bullish and as well as in a bearish market conditions. But before we get started, make sure you like this video if you enjoy the content and as well as subscribe to the channel if you are new here so that you don't miss on my future content. So with the W pattern, we have the type 1, the type 2, the type 3 and the type 4. And how this particular pattern appears on the chart, it comes in these 4 forms. That is the first one, and the first one is something that we are all familiar with in our daily lives. It's just the normal W that we expect to see when someone mentions a W. And with the first one, it has what? The first low and the second low are all equal. And the high and the high here, they are all equal. And when this particular one forms in a chart, you expect the market to trade back to the neckline. And this scenario I'm showing you here is going to happen 90% of the time. This particular this particular W pattern is going to complete at the neckline. You can go into the chart, you can pick any pair, whether it's a forex, crypto, a commodity, or a precious metal. You can just pick any trading pair, even a stock, and backtest this W pattern. You are going to see that 90% of the time, out of 10 that will appear on the chart, you see that 9 of them is going to complete at the neckline. And we also have the type 2. And with the type 2 is the one that have a failure swing. And with that one, the first low is lower than the next low. That is, it creates a lower high. And with this particular one, it also has what? The highs being equal. And with this particular one, you also expect it to complete at the neckline. So anytime you see this one forms, you expect the market to trade back to the neckline. And we also have the type 3. And the type 3 is the one that has a lower low. It has a protruding swing to the downside. And with this one too, it has equal highs. The high here and the high here are all equal. And with this one too, we expect it to trade back to the neckline to complete the pattern. And we have the type 4. And this particular one is what actually makes pattern complicated in a way, because the type 4 has what? An extended swing. That is, the first high is lower than the last high. This high here overextends more than the high here. And the problem is that when the type 1, type 2, type 3 are all forming, you can't tell whether it's going to be, they are going to have all equal highs, or it's going to be like the type 4. So this is where the W pattern get tricky. So this is the area you have to combine your other knowledge of market structure, shift in market condition, your other indicators that you have backing you to be able to trade the market back to the neckline and other stuff. So with the type 4, you expect the market to do what? To trade at least to the high of the last swing or all the way back to the neckline. So with the LW, these are the 4 scenarios you can see it form. And with the type 4 too, it can come in the form of either the type 3 swing, the type 2, or the type 1. That what I'm actually trying to tell you is that it can form like this. or it can form like this, or it can form with equal highs. The only difference is that it overextends at the top. And with this particular pattern, the W pattern, the way you trade it in a bullish market is that if the market is bullish, you expect it to stop around here, then go up. So in a bullish market, if you are trading a bullish market, your point of interest is of trading the W is around here. You only trade it here if only you are good at doing what? Doing counter trading. But in a bullish market, your point of interest is around here. And in a bearish market, your point of interest is around here. In a bearish market, this is where your point of interest is, because in a bearish market, you don't expect it to stop at the neckline, but it is where the pattern completes it. But in a bearish market, it will normally not stop here. It will overextend down when we were in a bearish market. So in a bullish market, whilst your point of interest is the neckline, in a bearish market, your point of interest is the high of the W. So are the two differences, and are the two scenarios you trade it if you are in a bullish market as well as if you are in a bearish market. So let's go into the chart and see how we can actually trade this W in a bearish market, and as well as how we can trade this W in a bullish market. All right, we are now going to look at how you can apply this particular W concept into your trading. That is how you can put it into practice in a real trading chart, because how you see me do it in this video will not be how it will appear in the chart. You have to train your eyes to be able to see it, identify it, and trade it. So let's look at how you can apply it in a bullish market first, then we'll go and look at how you apply it in a bearish market, and we'll be using Ethereum USD for all these two demonstrations. So first, let's look at the Ethereum USD in a bullish scenario. So let's cut off the chart around here. So as you can see, from all the way down here to here, the market was what? In a bullish environment. So let's zoom it out and go down and see the W patterns and how the market actually reacts to them. All right, here we don't have one, we don't have some here. All right, we have some here. Let me remove this EMS. You can see we have, when you come here, we have a W around here. And know first that the market is what? It's in a bullish condition. We have a W here. We have it here. And I told you, in a bullish condition, you expect the market to do what? To trade to the neckline. And this is where? This is the neckline. You can see that the market did what? The market even traded below the neckline, but see the body of the candle? The body of the candle never closed below the neckline. And after that, the market pushed to the upside. Let's look for another one. If it was to be in a bearish market, you see that it would have broken this. It wouldn't have put to the upside, it would have broken it. We'll look at the bearish condition too. All right, here we have another W again. We have a W here. You see it? And the market traded right to the neckline. You can see it. Right to the neckline. And did what? And pushed up. The market never broke the neckline. It pushed up. This is our second example. Let's find a third one and go into the bearish scenario. Let's look for a third one. Where is a third example? All right, this is a third example. It's a very big one, of course. This one here. You see, the market came down. It didn't make its way to where? To the neckline, and stop there and pushed up. Unfortunately, it stopped at this other block here, but the other block is just around the neckline. It didn't make its way to the neckline. It stopped there and pushed up. So you have seen three examples how this market, or how the market actually react to the W pattern in a bullish scenario. So let's go to the bearish scenario, then we see how the market reacts to that one too. We are now going to look at how you can trade a W pattern in a bearish market. And I told you in a bearish market, we will expect the market to not only trade with the neckline, but breaks the neckline and create a low. So we are using the same Ether or Ethereum USD for this demonstration. And from all here, you can see it's a bearish market. So let's zoom out and try to find the W's in them or in the chart and see how the market actually plays out around it. No, no W, no W, no, no W. Okay, there's a W here. And the market traded to where? The neckline. And at this particular time, the market did what? It failed to do what? To break below the neckline. So this particular one, the market failed to do what we expect it to what to do. This is one of the things of trading. You are not going to get 100% of all the trades you take. And we also have another one here. This is another one. You can see it. And the market did what? The market didn't stop at the neckline. You see, when it came to the neckline, it stalled for a little while, but it broke down. And we are what? We are in a bearish market. We come down again. We have another one here. The market did what? The market is now melting down to the downside. You can see it. The market is now melting down. So this is how you trade the W formation in a bullish and as well as in a bearish market. So thank you for watching this video. I'll see you in another video.